Hi, and welcome to Symax Fintech weekly report. This is part one. Here we're going to cover some of the macro and then we'll come into the technicals on part two and part three. First of all, our disclaimer, please read it carefully. Trading involves the risk of loss of capital and it's not suitable for everyone. Hopefully it is for you. And many companies provide leverage, so you should be aware that you can lose substantially more than your initial investment. The views, opinions formulated in here are mine, Chris Tubby, and all we're trying to do is provide you with some just insight into what's going on, but it is purely for educational purposes. So it's not investment advice, or we're not encouraging you to trade or invest. That has to be your decision. And of course, you should carefully consider your risks, your financial situation, definitely your level of experience, and obviously only risk capital that you're prepared and, more importantly, can afford to lose. You should seek financial independent advice if you have any doubts whatsoever before you risk your capital. So highlights of last week, just again, all about inflation. We had CPI, PPI out across various countries, including the US, and it's still pushing forward. It's getting very close to peaking, and that's going to be a sort of a mixture of not so much the supply chain issues, but the fact with interest rates going up and prices going up so much that disposable income will reduce. And then, of course, the main focus that goes with that at the moment in the markets is the continued interest rate increases that we're going to see into 2023 in the majority of parts of the world. Stocks sort of started the week lower. Friday they had a better day. Let's wait and see what Monday brings there. And of course, gold's been under pressure, dropped below 1800. Oil extended strong towards the end of the week, back up to the 110 level. It had dropped off, but the support's there. It seems that most traders are looking to buy that on the dips at the moment, just purely for fundamental reasons. And of course, the dollar continued strong as well. We saw again more weakness in the euro, the pound, and the yen, although the yen did have a recovery, so which is good to see. It was getting sold off a little bit too aggressively. Of course, the highlight, if you're following crypto at all, was the crash that was caused by Terra USB and Luna. It made Bitcoin go just above 25,000. It did recover though back to about 30,000. And of course, another highlight is the fact that Musk has put his Twitter bid on hold for the moment. He wants to see how many bogus accounts there. Is this a way of negotiating and getting a lower price than his $44 billion that he's offered? Or is he actually just trying to walk away from it completely? Let's wait and see. So key data this week, again, we've got some strong data coming out from the EU. We've got GDP and again, more inflationary data with the CPI. In the US, data is going to continue to show a strong economy, and we're going to see that in retail sales and industrial production. The UK, we're going to see CPI, so again, more inflation. We're expecting it sort of around about or just slightly above 9% at the moment. And that's because in the past month or so, we've seen that 54% rise in energy prices feed into the economy. Unemployment rate is continued, just carrying on, sort of expected to be around about the same, 3.7%. It's still very close to what it was pre-COVID. And of course, we're going to see those retail sales. The UK is having a little bit of a fight just because of inflation. And when inflation bites in the UK, it's usually pretty aggressive and it sort of if unchecked, can run rampant. So again, the Bank of England needs to watch out for that. China. So China's zero COVID policy impact could lead to another interest rate cut soon. They're going in the complete opposite direction of pretty much the rest of the world. And of course, their labour, inflation, trade and GDP is going to be released this week as well. So macro in outlook, it really hasn't changed much. Inflation, shrinkflation, stagflation, potential for recession, it's all still in there, and it's all still being caused by the same things. We've still got supply chain issues, and those pressures are going to remain all the way through 2022. And then, of course, you've got Chinese lockdowns, the Russian invasion of Ukraine, that war plus the China, they're causing more and more delays and supply shortages, increase in transport costs. And of course, as we see this inflation really take hold as we are, it is reducing consumer demand. It's giving people less disposable income. And of course, it's increasing borrowing costs as well. Of course, energy and food prices remain elevated. It's a bit of a repeat from last week. Lack of workers. In the US, over 4 million people changed their jobs in March. They left their current jobs, but that's all they were doing. They was going to new jobs where they were probably earning more money, or perhaps they had better conditions or higher status or something. Some of the EU states are potentially heading for a recession, or at least stagflation. Italy, but they're not the only one. I mean, even Germany could hit recession soon. And of course, in the EU, they're looking to raise rates, possibly from the July meeting. And it's possible that they'll go from their negative 0.5% to 0, or at least, well, not at least, but possibly up to 0.25% positive by the end of 2022. But let's wait and see on that, because they still sort of pretty cautious. They're talking it up, but let's see actually, what they do as we go along. We shouldn't anticipate them too much because they can surprise from time to time. US again, more 50 basis point rises coming, and then potential for them to drop down to 25 basis points towards the end of the year, depending on how inflation is. They seem pretty focused on inflation now and playing catch up still. And of course, there are expectations that we could see 3% by the end of this year. With the UK, yeah, we're going to see more interest rates increases this year, but there are economic pressures. We've got more challenges in the UK, and for me, that could reduce the number of expected increases, just because of the amount of pressure there is on households already at the moment. And of course, sterling is under pressure, as well as the euro at the moment. Just finally, here's our trading tip of the week. This is for you guys that use technical analysis. When you're putting those lines on, just make sure they are really accurate. And the reason for that, it's just even that odd 1 or 2 ticks that it could be out. It could be the difference between you getting stopped out in the market or making a profit. So, really zoom in and make sure you're just touching the bottoms or tops of those wicks or whatever you're using for your charts. Another tip is to add pivot points on using a 30-minute chart. And, indeed, as most of you do, you use candlesticks. I suggest you try adding Heikin-Ashi. It's not to replace it, it's to complement it. And it's just to help you identify the trend and potentially to see when that trend is changing. And you can use that on a variety of time frames. Again, as usual, if you need any help with pivot points, Heikin-Ashi, or anything to do with trading, we do hold one-day workshops, and we do hold one specific on technical analysis. If you contact us, we can give you the dates for that. So thank you very much. Hope you've enjoyed this. Just got the disclaimer and contact details coming up now, so please stay and watch them, because they're very important, and we'll help you as much as possible. Again, there's just another reminder of our disclaimer. I went through it at the beginning, so I won't bore you with that again now. And some of our services that we do provide, our daily newsletter, which includes a lot of all this up-to-date global news, as well as chart levels and some views as well. We offer workshops, courses, master classes. We do trader mentoring. We consult. If you've got any questions whatsoever, feel free to reach out to us and contact us at info@symaxfintech.com. So that's the end of part one. Hope you've enjoyed that. We're just about to start part two now, and we look forward to seeing you on that one as well. Thanks for listening.